Mutual funds have long been one of the most accessible and widely used investment vehicles in the world. Yet, many beginners approach them with a mixture of curiosity and confusion. They hear the term tossed around in conversations, see it listed in retirement plans, and often assume it is something one should invest in without truly understanding how these funds work or what makes them different from other investment tools like ETFs or individual stocks. But mutual funds, when understood correctly, offer something incredibly valuable, a way for ordinary people to access diversified, professionally managed portfolios without needing to be experts themselves. They were built to simplify investing, not complicate it. And once you peel back the layers, their structure reveals a quiet elegance that has served millions of investors for decades. At their core, mutual funds are pooled investments. Imagine a large group of people, each contributing different amounts of money into a shared pot. That pot is then managed by a professional or a team whose job is to invest it according to the fund's stated strategy. This means that instead of trying to pick and manage dozens of individual securities yourself, you entrust that responsibility to someone whose full-time job is navigating the markets. For beginners, this can feel like a relief, a chance to participate in the market without carrying the heavy burden of research, timing, and constant monitoring. But this convenience comes with nuances that every investor must understand before diving in. One of the defining characteristics of mutual funds is that they are priced only once per day. Unlike ETFs, which trade throughout the day like stocks, mutual funds calculate their price, their net asset value, or NAV after the market closes. This means investors cannot react instantly to market movements. They must instead accept the end-of-day pricing. While this might feel limiting to some, it actually protects beginners from impulsive trading driven by emotional swings. In many ways, the structure of mutual funds encourages long-term thinking rather than quick speculation. But mutual funds vary widely. Some are actively managed, meaning a team of professionals analyzes companies, forecasts market trends, and makes decisions in an attempt to outperform a benchmark. Others are passively managed, simply tracking a market index much like index ETFs. Active funds offer the potential for outperformance, but they come with higher fees, and countless studies have shown that most active managers fail to beat their benchmarks consistently over long periods. Passive mutual funds, on the other hand, offer low-cost access to broad market exposure, making them a favorite among long-term investors who prefer simplicity and stability. Understanding fees is one of the most critical parts of decoding mutual funds. Many beginners don't realize that mutual funds can carry a wide range of costs, expense ratios, management fees, sales loads, redemption fees, and more. These costs may seem small, but over decades they can significantly affect returns. A fund with high fees must outperform its peers just to break even. For this reason, low-cost index mutual funds have gained enormous popularity. They avoid the drag of excessive fees while providing exposure to entire markets. When you invest through a workplace retirement plan, such as a 401, many of the available options are mutual funds, and knowing which ones have reasonable fees is essential to protecting your long-term growth. Another defining feature of mutual funds is minimum investment requirements. Some funds allow you to start with as little as $100, while others require $1,000 or more. This can influence how beginners build their early portfolios. ETFs, by comparison, can often be bought in small quantities or even fractional shares. But mutual funds, especially in retirement accounts, remain deeply valuable because they automate investment behavior. Many allow automatic contributions, which turns investing into a steady ritual rather than a sporadic decision. This automation, quietly maintained month after month, is one of the strongest drivers of long-term wealth. But perhaps the most overlooked advantage of mutual funds is behavioral. When you invest in individual stocks, it's easy to become attached to the story of each company. When one stock declines sharply, panic sets in. When a stock surges, overconfidence grows. Mutual funds reduce this emotional turbulence by blending many investments into one. Instead of feeling the drama of each individual company, you experience the smoother ride of a diversified bundle. This emotional buffering helps beginners stay invested during downturns, a critical factor in achieving compound growth over decades. Mutual funds also come in many flavors, each designed for a specific purpose. There are stock funds that invest in large, mid, or small cap companies. Bond funds that focus on government, corporate, or high yield debt. Balanced funds that mix stocks and bonds in predetermined ratios. International funds that explore global markets. And target date funds that automatically adjust allocation based on your expected retirement year. This variety allows investors to build an entire portfolio using mutual funds alone, choosing combinations that suit their risk tolerance, goals, and time horizon. But with variety comes responsibility. Not all mutual funds are good. Some are overpriced. Some are poorly managed. Some have inconsistent strategies or take excessive risks behind the scenes. Others simply fail to outperform simpler, cheaper alternatives. The key is not to buy mutual funds blindly, but to understand their objective, their fees, their track record, and whether they align with your personal investing philosophy. A mutual fund is not just a product, it is a partnership with a manager's approach to the market. And choosing the right partner requires clarity, not guesswork. One powerful way to think about mutual funds is to imagine them as vehicles traveling different roads. Some move steadily along predictable highways, offering stability and modest growth. Others weave through more dynamic terrain, promising higher returns but demanding stronger nerves from passengers. Before you choose which vehicle to ride in, you must understand your own tolerance for bumps, speed, twists, and surprises. The right mutual fund does not challenge your nature, it supports it. And as your investing years unfold, you will begin to notice that mutual funds play different roles at different times in your life. Early on, growth-oriented funds may help you build a foundation. Later, bond funds or balanced funds may offer stability as your goals shift toward preservation. Finally, target date funds can act as a long-term autopilot, adjusting your portfolio as you approach critical milestones. This adaptability is part of the enduring strength of mutual funds. They evolve with you, quietly adjusting to the rhythm of your life. But mutual funds also come with important limitations. They cannot be traded intraday. They may distribute capital gains, creating tax consequences even when you haven't sold your shares. Active funds may underperform despite high fees. And some fund families prioritize sales commissions over investor outcomes. Understanding these limitations helps you use mutual funds wisely, treating them as tools, not magic. As you continue your journey, you begin to see that mutual funds are not about chasing spectacular gains, but about cultivating steady, disciplined growth. They were created to democratize investing, to make markets accessible, and to give ordinary people a chance to build wealth without overwhelming complexity. They invite you to trust the long arc of economic progress rather than the daily noise of market sentiment. And once you appreciate this, you realize that learning about mutual funds was never about memorizing financial terminology or decoding complicated charts, but about learning, to trust a process that grows slowly, faithfully, and often invisibly. Because mutual funds, at their heart, are not designed to thrill you, but to carry you. And as you continue forward, the truth becomes clearer. The real value of mutual funds lies not just in the assets they hold, but in the behavior they encourage. They invite you to think long-term, to stay consistent, and to let compound growth work without interruption. As we continue from that thread, it becomes important to understand how mutual funds shape the emotional and psychological journey of an investor. When you invest in a mutual fund, you surrender the need to constantly make decisions. You no longer have to evaluate which stock to buy, which bond to sell, or when to time the market. Instead, you step into a system built on rules, structure, and discipline. This structure is not restrictive, it is liberating. It frees you from the constant buzzing of market noise and allows you to focus on what truly matters: your contributions, your goals, your patience. One of the quiet strengths of mutual funds is their ability to turn investing into a habit rather than an event. Automatic contributions mean you invest at market highs, at market lows, and everywhere in between. This rhythm slowly detaches you from emotional decision-making. Instead of waiting for the right moment, you are always in the moment. Over time, this habit builds something far more valuable than perfect timing: consistency. And consistency is what turns beginners into long-term investors. As mutual funds become familiar companions in your journey, you begin to realize how versatile they are. A single fund can expose you to hundreds of stocks or bonds, offering diversification that would be difficult and expensive to achieve on your own. Balanced funds, for example, adjust the mix of stocks and bonds for you. Target date funds gradually shift towards safety as you approach retirement. International funds widen your horizons beyond your home country. Bond funds offer stability when life demands steadiness. Equity funds offer growth when your timeline allows patience. Each type plays a different emotional and financial role, like instruments in a quiet orchestra shaping the soundtrack of your future. Yet the more you learn, the more you understand that mutual funds are not flawless. Their strengths come with responsibilities. Actively managed funds may trade frequently, triggering taxes in taxable accounts. Some fund managers take unnecessary risks to chase performance. Some funds carry hidden fees or confusing structures. This is why learning to evaluate mutual funds becomes part of your evolution as an investor, not to turn you into an expert analyst, but to help you make decisions grounded in clarity rather than assumption. Evaluating a mutual fund begins with understanding its purpose. Does it seek growth, income, stability, or a balance of these? Then comes cost. Are the fees reasonable for the service provided? Next is track record. Not just returns, but consistency, risk level, and behavior during downturns. And finally, alignment. Does this fund match your temperament, your timeline, and your goals? A fund that conflicts with your emotional comfort will eventually push you into mistakes. A fund aligned with your nature will support you through volatility. As years go by, mutual funds begin to play a deeper role in your financial identity. They help you transition from someone who reacts to the market to someone who responds thoughtfully. They offer continuity even as markets shift. They help you achieve the quiet victories that compound over time, your first $10,000, your first $50,000, the day your gains exceed your contributions, the moment you realize your portfolio is working harder than you are. These milestones rarely come with fireworks, but they mark the slow blooming of financial independence. One of the most powerful aspects of mutual funds is how they encourage patience. Since they don't trade intraday, you are less tempted to monitor them constantly. Since they are diversified, you are less shaken by the temporary decline of any single stock. Since they are designed for long-term growth, you begin to measure success not in days or months, but in years and decades. This mental shift away from urgency and toward endurance is one of the greatest gifts investing can give you. Eventually, you come to understand that mutual funds are not a shortcut. They are a partnership with market history, with diversification, with disciplined management, and with your own future. They are built for people who want to grow steadily without turning their lives into full-time financial analysis. They are for people who believe in the long arc of progress more than the chaos of daily headlines. They are for people who would rather build quietly than gamble loudly. And as this guide comes to its final arc, one truth stands out more clearly than all the others. Mutual funds succeed not because they are complex, but because they simplify. They take the overwhelming landscape of investing and condense it into something usable, approachable, and human. They allow you to build wealth without sacrificing peace. They allow you to participate in economic growth without pretending to predict it. And they allow you to live your life while your money works calmly in the background. So if this exploration of mutual funds has brought you clarity, if it has helped you understand your options, reduce your fears, or sharpen your direction, I warmly invite you to share your thoughts or reflections. Your words help me see which parts of these lessons resonate deeply. And if you'd like to continue learning with me week after week, feel free to subscribe or follow so we can keep unfolding the gentle, timeless wisdom that turns beginners into steady, confident investors.